Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results. Good morning, everybody. Welcome to See the Futures. My name is Jim Cagnino with NinjaTrader. It's January 17th, 2024. Didn't accidentally say 2023. I'm on my game today, Wednesday. Happy Wednesday. Thanks, everybody, for being here with us today. Joining me live, very special guest, the fabulous Bobby Iaccino. Good morning, Bobby.
Morning, Jim. You didn't sound too confident that it was 2024 there. I wasn't sure if you were positive about that or not.
I had to did you see me look over at my cheat sheet?
Yeah, I did.
Oh my God. How's your New Year been?
So far, so good, but no resolutions for me. That's not something I do, but I did actually set some goals for the year, which I think are different than resolutions. Because with resolutions, people are usually trying to change a behavior or something. So I like to do goals. And one of my goals is 3 Thomas Sowell books this year. So I'm halfway done with my first one, which the title might upset some people, but it's still a book by an economist. Can you see this?
Yeah.
Social Justice Fallacies. And there's my trading card bookmark. So I started that at the beginning of the year. Some great stuff in there already. He's my favorite economist ever. So I'll knock 3 of those out. And if I get 3 done and there's still a quarter left, I'll go for a 4th.
So that's interesting. I see him on Twitter a lot, and it's like the impression is that he was an economist from yesteryear who's passed on.
Yeah,
right. It just gives you that feel, right? That he's not like a real contemporary guy, but clearly he is.
I will openly weep when that day comes because he is 93, but he's still very, very well spoken, very just still bright, and you can go back and watch speeches of his and what else would you call it? Debates of his from back in the late 60s, early 70s. You can find those on YouTube. Just spectacularly sharp guy.
Yeah, that's awesome. That's awesome. Well, it's good. Those are great goals, right? Educating, getting smarter, getting better, improving yourself. I love that. So let's talk about that. This has been on my mind for a while, and I feel like it's an underrated issue. You know, we could talk about a little bit about a geography lesson here, but this Red Sea thing seems to me a bigger deal than it's made out to be.
Yeah, it is, I think. And I think the market doesn't quite have it priced in. And part of the reason I don't think the market has it priced in is because it seems to have been muted so far. So let's talk about why the Red Sea matters first. It is a vital waterway for world trade. I mean, you're talking about 12% of world trade. Okay, massive. Almost double digits for crude oil, right? For crude oil and crude oil products, call them distillates, right? And it leads to the Suez Canal, which is a choking point, right? So you got attacks that have been happening for months now by the Houthi rebels that come out of Yemen. Now, one of the things that hasn't happened so far was an oil or distillate tanker has not been attacked in any significant way. But somewhere in the range of 180 cargo ships have been forced to change course or over the course of about 200 reported attacks, right? So there's been 200 reported incidents from cargo ships through the Red Sea. Some of them have been boarded and pirated, for lack of a better phrase. Some have just been attacked by drones. And it's not elegant in terms of diverting or attacking those drones. So one report stated that the Houthi drones cost them somewhere in the range of $2,000 to $3,000 to build and launch. And the defenses that NATO allies have against those individual drones cost somewhere between 1 and 2 million each. So it's not really a balanced attack and defense sort of equation, right? So the allies have to kind of be calculated in terms of the ones that they attack and stop and the ones that they just kind of let go. Somewhere in the range of 170 vessels have been forced to change course so far. And that course change is anywhere from 90 to 120 days extension of that particular line. So they have to leave the Red Sea and go around the Cape of Good Hope, which we all know is Africa, right? Now that also takes into play on the eastern, I believe it's the eastern coast of Africa, could be the western coast, but I think it's the eastern coast. There's pirates, right? Somali pirates and others that also tend to divert ships and increase the cost of shipping because you need security against those particular pirates. That's something that the Red Sea has always promised, is a little bit of a lowered cost. So you not only have a lowered cost in terms of the distance traveled by the ships, but in terms of the defenses that the ships have to pay for and muster to go around the Cape of Good Hope. So it's a lot. Now, a lot of our asset base, our commodities, whatever else you want to call them, our shipping lanes, have priced that in. Okay, shipping and freight rates have gone up, but not enough, in my view, to sort of derail a worst case scenario, which would be energy and would be crude oil ships. And you're not seeing that. And part of that is because a lot of this is my opinion, by the way, okay, not anybody else's. Part of the reason you haven't seen attacks on oil and distillate vessels is because countries that produce large amounts of oil and distillates for export financially support the Houthis, specifically Iran.
Okay, so let's talk about that for a second. So from a supply chain point of view, we're talking about commerce that's coming from India, Asia, Singapore, all the way through the Indian Ocean. They got to navigate up through the Somali pirates, which are actually on the East Coast, yep, and then go up through the Red Sea, Suez Canal to the Mediterranean, where they can unload or continue on to the U.S. Right? Yep. That's what the commerce stream is right now.
Yep.
And depending on who you are, you may not be welcome. You might have to cut all the way under, like you suggested.
Yeah, one of the things that's happening in terms of like driving up freight costs is they call it the off flagging, all right, of certain vessels. So in other words, a vessel is coming from, I don't know, pick somebody, doesn't really matter. Let's say Egypt, okay, it needs to go through the Red Sea, and Egypt isn't necessarily someone who supports the Houthi rebels directly. They have to flag it differently. So they need to pay for that right to flag the ship as something else. So that, again, is something that's added to the cost of shipping. And the interesting part is, for the most part, the drop in inflation that we've had, let's just take the US, for example, okay, the drop in inflation that the US has had from 7% plus to 3% plus has been because goods inflation has been falling. It's not been services inflation. So when economists and strategists like myself, I'm a strategist, not an economist, start to talk about the decline in the rate of increase of prices, it's all goods. Okay, services inflation is actually still running 5% plus. And so is wage inflation, 5% plus. And when we talk about the sticky components of inflation, it's in the services sector. Okay, it's in the wage component. So looking at it from a perspective of the possibility of the Red Sea situation boosting goods prices, that is a bad stew. Okay, those are bad ingredients to throw into the inflation soup, so to speak, because goods are the only thing that's pushing inflation lower.
Yeah, and we didn't even talk about the insurance costs to participate in this region. The shipping companies, they're getting hit with big insurance costs now. Say, oh, if this is where you want to operate, you're from these countries, you're going to have this extra premium you're going to have to pay on your insurance to add to your costs, to add to your time, to add to your hassle.
It's absolutely true. And that's one of the funny things about insurance is one of the things that Janet Yellen and the rest of the sort of West said they were going to use to cap Russia's price of oil. In other words, they were going to put pressure on the companies that insure those ships to not insure ships where Russia's cargo was priced at too high of a price. And I believe the number they set it at was somewhere around $60. Didn't work at all. Didn't work at all. The insurance companies did not bow to the pressure because they do bow to this kind of pressure. Okay, the idea that somehow the US or the West would sink Russian oil vessels that were insured by companies who allowed them to sell their crude oil at market price if it was above $60 is not viable. It's not realistic. Not something that would happen. The West would not sink a Russian oil tanker. Therefore, the insurance companies didn't bow to the pressure. These ships can be boarded, pirated, and potentially damaged to the point of being sunk. Now, again, it has not happened to oil vessels, but has happened to freight vessels. And so you're starting to see not only the cost of security for those ships, but hand in hand with that is the insurance that you mentioned. This is something where insurance companies actually do bump up the rates, and it just gets pushed down to the consumer. And we haven't seen the larger extent of it yet because the US and their allies have said we will defend ships in the Red Sea and in the Suez Canal. And so far, they've only been marginally successful because of the cost imbalance of defending those ships.
So, just when you say freight,
yeah,
right, in my mind, it's like container ships, right? You get the containers, they look like you put them on a train, yep. A railroad, ship them around or put them on a truck. And then I've seen, I got a tour of the Port of Carolina, and they actually have this system for actually transporting automobiles also, which is pretty cool.
Yep.
And so those are the ones that we're focused on. Bank of America, not too recently, it might have been today, it might have been yesterday, said, there's freight costs now are 120% higher than they were 120% higher than they were 6 weeks ago, mm-hmm. which means if it cost you $3,000 for a container, now it's costing you, $7,000 for a container.
Yeah, and that again, that kind of thing just directly goes into prices. Okay, it's not something that they eat. Okay, they just don't. For example, Statistica, which you can look at their free website. They give you a lot more if you subscribe, but you can just go ahead and you can sign up, accept the cookies, and they'll let you go. Okay. Their container freight index in November of 2023 sat at 1384. Today it's 2670. It's 2006-70. So that's an index. That is the highest. The only free chart you can get goes to about a year back. Okay. And then you have to pay for more than that. That's more than 1.5 times the highest rate in 2023, which was 2132, right? So it's 2670 now. And it is a parabolic spike in freight. Now, this is listed as the January 4th, 2024 rate. Okay, now go back to what we just saw in the retail sales figures. Okay, retail sales were up 0.6% month over month. December 21st of 2023, okay, the global container freight rate index from Statistica was 1661. It's almost 1,000 points higher now, okay? Go back to October 26th, 1342 was the level that it was at. Again, it's 2640 as of January 4th. So that's just sort of a statistical bias or basis, I should say, of what has happened to freight rates, container ship freight rates. This will come in to the next 3 months of inflation numbers. It will show up in goods. Now, whether other things offset it or not, I'm not sure. Take something like the Manheim used car index. Okay, now I'm talking to inflation and not the Red Sea. Okay, used cars, shipping rates don't matter. They're here already, right? They're just getting resold. The 3-month annualized rate of the used car index is now rising higher than the pre-pandemic levels. The rate of change of price is rising higher than pre-pandemic levels. It's 32% below the pandemic high, but 21% higher than pre-pandemic levels. Okay, so used cars locally are going up. You add to that the Red Sea problems, adding prices to container ships, which will all get pushed down to the consumer level at some point. And you're looking at what might be, again, a pretty bad stew for inflation numbers over the coming months.
So you talk the used cars thing is interesting to me because it's always been in my mind when used car prices are up, right? Or you can get more to sell your car to a used car lot. Then that usually is associated with bad economic times.
Yeah, I mean, used car pricing means that people are going toward used cars, and this is what you're saying, right? They're buying used cars that can't afford new ones. Now, that either means new car prices are extremely high, which I still think they are. They have not dropped along with inflation at the rate of inflation. But even if they had, okay, that means, and we've done this example before, right? A new car in 2019 that was $30,000 at the peak of inflation in 2021 moved up to, I don't know, let's say $42,000, right? And now that car is $43,000. So the rate of the move in price slowed considerably, but it's still 10 to 20% higher than it was prior to the spike in inflation that we saw. Okay, now people's wages have gone up. In some cases, they've caught up. In other cases, they haven't. It depends on the industry and the product you're looking at. But prices are still rising. So people go to used cars. Now, used car prices actually went into a slight deflationary period where they actually dropped in price, right? Slightly below pre-pandemic levels. They're 21% higher than that now. So look at that as being, and the Manheim Index, the reason I look at the Manheim Index is because it's weekly data. So you get an update all the time, and it is not survey data, it's actual price data, okay? So you're looking at a situation, and the reason I say it's not survey data is because it's not like the renters index that's a part of CPI where they call homeowners and say, what would you rent your house for, right? This is actual data of prices of cars sold. So you look at it from that perspective, it's real hard data, and you're seeing car prices, both new and used, rise. That's a little bit of a warning sign to me because not only does the used car price index matter down at the consumer level, but it also correlates, believe it or not, with manufacturing PMI at about a 93% rate. So that means that manufacturing PMI might be headed higher. It's not a guarantee. If that's the case, you telling me inflation is coming down? Probably not.
So let's bring this back. Let's bring this back home now. So we have these goods and possible additional goods inflation from this drama that I'm going to call it drama. Yeah. And coming in, it probably hit the numbers in January more so than December, February even more so, possibly if this isn't resolved quickly.
Yeah, absolutely. And I mean, it's been going on for months, and there's no sign of it being resolved quickly. So that's part of the reason that you've seen the U.S. kind of change their tune with the, let's call it a Hamas-Israeli conflict, and kind of change their tune. The Biden administration has now started to talk more forcefully about a ceasefire because that's likely the only thing that stops it, right? Because the Houthis are, on the side of Hamas. Doesn't matter what side you or I are on at all for the purpose of this conversation. They're on the side of Hamas. So is Iran. And now, very recently, Iran actually attacked U.S. Properties, for lack of a better word, in Iraq, which the U.S. warned them not to do. And then they subsequently did a couple of days later. I believe it was a U.S. consulate, possibly an embassy. Don't quote me on what got attacked. So it seems more like it is ramping up slowly rather than turning in the other direction. That's what it seems like to me. And I'm not a geopolitical expert. Yeah.
Okay. But the punchline here for me is this is just another stress, right? That the Fed has to deal with. Another data point, another stress that they have no control over that they have to deal with. And it seems to me the equity markets right now are reacting to where they think, whether or not we're going to have a March rate cut. As far as I could tell, it seems like earnings are okay. It seems like everything's pretty good. And you have this situation where you get these sell-offs when it looks like the Fed funds tool is going to 50% instead of 70% for a cut in March.
If you look at it let's go back to a month ago, okay? The probability for a January rate cut, okay, a month ago for a January meeting cut, right? The meeting is January 31st, if I'm reading this correctly, was 4%. It's nothing, right? Today it's 2%. So it dropped. We can go to the probabilities tab, which you and I look at these all the time, right? And as of a week ago, the market had 7 rate cuts, 25 basis points each, priced into the market, right? 175 basis points in rate cuts. Now it's 150, right? They've taken one of those away. It's 6 rate cuts being priced into the market now. The funny part about this to me is the Fed, in their summary of economic projections, the SEP, which we all know as the dot plots, the majority of those giving their economic projections, and that's of the FOMC members, had 3 rate cuts. Okay. The rest had virtually none or 1. And then a couple of them had 4. The market has 6. Okay.
Yeah,
so
let me show that. Let me show that on the screen right now, just so everybody can get a sense of the difference between the market driven expectations and what everyone else is saying. Here it is. I mean, here's the probability table right here saying, hey, end of January, we'll be tracking, if the teal tabs are the winners, we'll be tracking between 3.75 and 4.0 in the Fed funds target.
Yeah, and they have the first one priced in March, but that's dropped down to only a 55% probability. That probability has been high as 80 some odd percent. Okay, if you just go back to, where was it? I'm sorry, correct, on a week ago, it had a 64% probability that we were going to get a rate cut in March. Now it's 55, right? So this happened last year as well, by the way. Last year in 2023, if you were watching this probabilities tab, which is the thing I watch almost more often than the target rate tab, the current, right? This probabilities tab tells you what the market is looking for in the future. And in 2023, it had rate cuts being priced into the end of 2023 and the beginning of 2024. And then those slowly went away as data told us otherwise and that the Fed speakers told us otherwise. I do believe the Fed has pivoted their stance. Okay, I do believe that now they're talking about a very slim probability of one more hike and a likelihood of cuts. But it's still likely that these 6 cuts are going to be priced out by the market because I don't think 6 cuts are going to happen. And the equity market, as little as a month ago, was pricing in that 6 cuts were going to happen. And that's starting, if you look at an S&P chart or a NASDAQ chart, I don't care which one, you're seeing it sort of roll over and start to price these things out. I'll point to something else. The 2s, 10s inversion, okay, and this is the 10-year yield minus the 2-year yield, okay? That's sort of the one that we all kind of immediately look at to see where the yield curve is and if the yield curve is inverted or normalized, right? It settled at negative 15 yesterday. It's been as low as negative 109. That is the lowest that I've seen in my career. It's the lowest since 1950. And it's also stayed inverted for the longest amount of time since 1950. And people, for some reason, think that that large inversion and that extended inversion moves us further away from a recession rather than increasing the probability of when rather than if we're going to have a recession. I'm in the latter of that. I think it's a matter of when. But I will tell you that when you look at the market doing what it's doing now, if there's going to be a recession, and by the way, the reality of it is I don't care if there's a recession or not, because stocks tend to fall at the beginning of a recession. The recession generally begins after the 2 cents inversion has left its inversion and normalized. In other words, gone positive to where the 10-year yield is higher than the 2-year yield, which we currently don't have. Okay, the current scenario is that the 10-year is actually below the 2-year yield by about 20 basis points, right?
Yeah.
10 years
Yeah.
about 411 and the 2 years somewhere around 430 or so. It's just a guess.
Right. I thought we were going to do it on the CME group. Sorry to interrupt, but on the CME group micro yields, I thought we were going to do it today. We were getting close yesterday.
Yeah, we were getting really, really close. We settled at negative 15 yesterday. But the recession tends to begin after the inversion has gone to zero and turned positive again. The recession tends to begin then, not while things are still inverted. And the equity markets tend to collapse and then bottom, and I'm talking about a long-term bottom, after a recession begins and after that inversion has gone normal again. Why would that be? Because the Fed begins to aggressively cut rates to rescue everybody, to rescue the equity markets and to pull the economy out. They haven't done that yet. So I'm looking forward to the recession from an investment perspective, not from a Main Street perspective, right? But it just becomes a more comfortable time to put on longer term longs if a recession has actually begun already.
So I'm not too far off the idea that, hey, this equity markets are looking for potential rate cuts going forward at some point.
You're dead on. That's what the market's looking for. I just think the market is being too aggressive because the data doesn't, to me, say that the Fed can do it. Now, if they do it, a lot of people would chalk it up to politics because we have an election. Now, the Fed has, by the way, for everybody here listening that said the Fed always cuts before an election, no, they don't. As a matter of fact, they've hiked before elections before. Okay, they have. But it does stand to reason that if the Fed is going to maintain credibility, if they do cut, it'll be mild. And it'll be closer to the time of the election simply because they want the rate hikes to bite a little bit more, not because there's an election coming up, in my opinion. You could tell me that I'm crazy and naive if you want to.
You're not. I've done I don't know, 100 man hours trying to find a correlation here between cuts, FOMC behavior and an election year, and there's nothing there. There's no correlation I could find. So I'm with you on that. But having said that, we're looking at this E-mini S&P chart right now. We had that tremendous rally. This is a daily candle chart, right? We had that tremendous rally. We had maybe a double top if you use your imagination. And now we're having a little bit of a retracement, but we're still pretty range bound, right? We're still above that 47.28 where my crosshairs is.
So leaving that chart up, that is a sloppy double top. Okay, it's not a perfectly formed double top, but it is a double top. So you pointed to the left-hand high at one point. Okay, well, in this conversation, you were running your cursor over the left-hand high, which is somewhere around there. Okay, if you take that high tick, whatever it is, I think it's one to the left of that, but I could be wrong because I can't see your chart well. And you measure
they're pretty much the same, right? They're around, let's just call it 48.40.
Right. If you take that high tick and you measure the difference between that and the low tick to the right of the high tick you just pointed out. Okay, measure that distance and then subtract that from the low tick. Okay. So if you take that down to that low tick, okay. Now grab that and add it to the low tick. Yeah, that's your target. Now that's your target if we get a close below that low tick. Talking about a close. That close would also likely close below the 50-day moving average. They're not lined up yet, but because the 50-day has more data in it, it's likely to continue to trend slightly higher and then possibly flatten out somewhere right around that same low. So if you get a close below those two, not only that low, but also the 50-day, that's your measured move target right there, the bottom of that line you drew, the vertical line. So that's your target. Now, the market will have a hard time getting below the flat level that you can probably just clearly see to the left. Yep.
Yeah.
Right above it. It'll have a little trouble getting below that. But once it does, it'll likely hit your target and probably extend to the 200. And that 200 probably lines up right now with the flat level that's all the way to the left of your chart.
How do you do with that box?
Yeah. Now look below. Yeah. See where the 200 is? That line's the 200 right between the 2 and the 4 where it says ES March 24. That lines up
Yeah.
pretty close to the flat level that's all the way at the left of your chart there that you have marked up. They're pretty close. So
Got
it'll
it.
likely break the 200 on a spike below, touch that flat level to the left, and turn back up. That to me is a very solid medium to long-term buy.
Yeah, and just to put this in perspective, and I'm going to draw a fib retracement. I should probably check the clock. I don't know. Time flies when we're together. I'm just going to go ahead and put this fib line in, and I want to point out, this rally start is only 2.5 months old.
Yep.
And so, from a retracement point of view, whether or not we get to a fib number or one of your levels, it's still, it could take a little bit of time, and it's still a reasonable retracement.
Yeah, it's a reasonable retracement. And my guess is it's somewhere in correction, Jared. Now that we've made a new all-time high, we're officially in a new bull market. Okay. And I've said it a million times, and people can disagree with me if they want. But if we reach a new all-time high, that is the only way that we get a new bull market. Right. So if we get down to that flat area of resistance around October 12th to October 17th, okay, if we get down to that, that's about an 8.7% move lower from the new all-time high. That's just a hair within correction territory.
All right. Well, we did it. As I thought, time flies when we're having fun. Our half hour together goes in like 5 minutes in my mind. But I appreciate you being here with us today and see the futures. Awesome information.
Good to talk to you as always, man.
All right. So real quickly, if you want to get a hold of Bobby, Twitter's the way to go?
Twitter's the best way to go. Bob_Iaccino. That's IACCINO. And we actually got a live show today at 4 p.m. Eastern time. So if you follow me on Twitter, you'll get information about that.
Yeah. If you want more contact information, just send me an email to learn, Learn, at ninjatrader.com. In any event, folks, thanks for being here. Oh, we got poll results. Sorry. Hang on. Poll results. I get so caught up in this whole thing. My brain is thinking. All right. Here's the poll question. Oh my God. What was Bobby's favorite book in 2023? And there's three choices. Choice number 1, Lord of the Rings, 36%. Choice number 2, Harry Potter and the Sorcerer's Stone, 9%. And then 54% said Dungeons and Dragons for Dummies.
You got the dummies part right. Most of my books end in for dummies. This is actually my favorite book.
The Parasitic Mind, Gadsad. Okay. Yeah. What is it about?
Basically, infectious ideas and how they kind of get entrenched in a brain with no evidence to back them up. It's a little bit of a conservative book. It was a very close second to another one that I read called, I can't remember it, but the author is Brett Weinstein. It was basically a survival guide to the 21st century or something to that effect. But him and his wife, Heather Hang, are both evolutionary biologists. So I read that one. And that one was, again, a survival guide. But 2024, I'll give you the answer to the poll question now. Something by Thomas Sowell. So when we do this again at the beginning of 2025, that'll be your answer.
Awesome. Well, again, I appreciate your time being here with me today and taking time out of your very busy schedule. We're going to look for you on Twitter and all the usual places that comes along with you and Jimmy and the gang. So thank you.
Good to talk to you guys.
All right, everybody else, thanks for being here. Appreciate your time as well today. I do want to remind everybody, most important message of the day, please be safe out there. Be good to each other. See you soon.